Again, welcome to this session where we shall be talking about project financial statement forecasting. In here, we are not going to be an accountant. We are not going to be the finance people, but we are going to forecast. We are going to forecast the financial statement. But again, when forecasting this, we need to align ourselves to other standards so that we should not be differentiating ourselves. When writing any type of project proposal, we say forecasted, or the so-called pro forma financial statements must be included. Must be included. It must be included because it provides an insight about an overview regarding the future health of the project itself. Therefore, it is important. It is important. You need to develop more skills and practice on how to do this. These are part of the attachment that you need to include when developing your feasibility study. They must be attached, and they are part of feasibility study, and also they are part in your proposal. You must attach it. Any investor would like to know what is the future financial flow of the project. The project can be of 10 years. A project can be of 15 years. A project can be of 5 years. A project can be of 3 years. But you need to provide a pro forma financial statement. They are based on the assumptions. They are not actual, but you predict the future. You predict the future flow of asset in your project. You predict the future profitability. You predict the future liability that you think the project will have to incur. You see how much they should be able to borrow, and so on. You predict. You better have pro forma financial statements rather than not having it, because at the end of the day, you may not know where you are going. So it is important for now to predict so that it gives you a roadmap on how you should go about it. So if you can forecast properly, it becomes easier for other people who will come and run in the project to work within the plan. It becomes easier. Investors will not look at a project that does not include a pro forma financial statement or forecasted financial statement. Investors will not be interested on that. So you need to develop this one. Forecast of the financial statements. It enables the project to adjust the plan before it gets into worse, and therefore working within the forecast, within the correct balance to achieve the desired targets. So you will realize that it is important. It is important for you to develop the forecasted financial statement, forecasted profit, income statement, forecasted cash flow, forecasted balance sheet. And because you know exactly, you have been involved in the exercise of developing costs and benefits. And therefore, if you have developed all costs, you have forecasted the future. If you have developed all revenue and forecasted the future flow of revenue, then it is easier for you to identify what should be the income statement, what should be the profitability. These are the questions that will be coming into your heads. What should be the future cash flow? What should be the future assets? At what time within that given period of time of the project we can buy vehicle? Should we buy vehicle at year 1? Should we buy vehicle at year 3? Or should we buy at year 0? These are things that you need to take into consideration when forecasting your financial statement, and that's why it is important. For forecasting financial statement, it's very much related to big projects, bigger project like school projects. School project, yes, you must include that one, unless otherwise if you're using donor funding. If you have to borrow from international community, if you have to borrow from China, if you have to borrow from any other sources that include elements of interest rates, then financial projection is significant. You cannot escape. So for bigger project like power plant project, software design project, road construction project, lodge and hotel project, real estate project, commercial poultry project. Maybe you want to go for lunch project. You see, baracoa or musk projects or textile projects, any manufacturing projects, commercial farm projects require a proper estimation of forecasted or pro forma financial statement in order to attract potential investor into the project. And therefore, you must get enough time as a project planner to understand about that one. Now, what should be the role of project manager in financial statement forecast? What should be the role for a project manager? Project manager must be forecasting the future flow of finance and plan it accordingly. So you as a project manager, you need to know the future flow of finance. If you know the future flow of finance, you must plan accordingly. And also we say a project manager must understand the project profitability from year 0 to the end of the project. You see, the starting time and the finishing time. So you realize that the project manager must understand that one. How much profit are we going to make? Project manager must know accumulated profit of the project, you see. And also, project manager must be aware with the future assets and liability that is going to be incurred within the project, you see. And also, it helps the project manager to work within the plan and adjust accordingly. Now, what should be the basic consideration for the forecasted pro forma financial statement? Number one, you need to make educated assumptions of future cash flow of all your fixed and your current asset and liabilities. You need to make educated assumption. For this one, there's no single formula because you need to predict, as I said earlier, when are you going to buy your vehicle? When are you going to employ staff? You see, if you have employed a project manager today, do you need a secretary? Do you need operation manager? Do you need any other types of managers? You see, because all this will vary. The situation will not be static. And what we say, get the forecasted income statement in order. You see, include all the sales, revenue, cost of goods sold, loss, profit, operating expenses, taxes, depreciation, plants and all equipment, and so on. Organize the statement of cash flow. In these documents include the net income, any sales or purchase of assets. Create a forecasted financial statement for the projects, duration from year 0 to the end of the project. So that is what in here I say we are not expected to become an accountant, but we want to develop those estimates that are clearly backed up with assumptions and remember, you cannot predict financial statements if you have not forecasted your cost and your revenue properly. So that you should not overcost, you should not undercost, but you should take a balance. And there is no single formula. So you are being backed up with assumptions. Assumptions will back you to defend whatever you are trying to do. So don't forget to include notes about your financial statements. Investors will want to know the reason behind how you arrived at the numbers. So anybody, might be the financial institutions, they want to know how you have arrived at those numbers. What are the key financial statements in the project? The key financial statement, these are the forecasted cash flow statement, forecasted income statement, and also forecasted statement of financial position, and that is the balance sheet. To start with, the balance sheet provide detailed information about assets, liabilities, and shareholders' equity. A sound project must normally present classified balance sheet, separating current and non-current asset liabilities. And also, during the project plan, it is desirable to forecast the project assets and liability required for the project to allow smooth operation in the future and attain maximum results. So you need to know the future assets. You need to know the future liabilities, you see, for things like non-current assets or the fixed assets. You need to know what are your assets derived from land? What are your assets derived from building? What are your assets from machines, motor vehicles, fixtures? All these must be forecasted at the beginning of your project. And these are non-current assets or the fixed assets. So you can develop more skills about that one by yourself. And also we say the current assets these are assets that are likely to change in a short term, that can be easily converted into cash. For example, you have your cash at hand, cash at bank, and also your stock. You can talk of liabilities. Liabilities are amount of money that a company owes to others. This can include all kinds of obligations, like money borrowed from banks to launch new products, rent for use of buildings, money owed to suppliers for materials, the payroll that a company you think will owes to its employees, taxes owed to the government. Liabilities also includes obligation to provide goods and services to customers in the future. And you also have shareholders' equity is sometimes called capital or net worth. And therefore, it is important also to predict this one. Now, let's see the example of what do we mean as a project planner. What do you want to include in your project? In your project, what do you want to include in there? Let me share with you this one. What you will have at the end of the day, as I said earlier, you need to have some assets. You need to have some assets. Like in here, the way it has been arranged. Remember, this is just the year one. This is just the year one. And you have the current assets, cash, you have account receivable, you have inventory, you have total current assets at the end of the day. You have fixed assets, you have equipment, you have less accumulated depreciation, if any, net fixed assets, you see, and so on. Then you have current liabilities, and just these are notes payable, accounts payable, wages payable. Then it will give you the total current liabilities. And you have the owner's equity, the stockholders, if any, for bigger project, if any. Not necessarily that all these components are going to be there, but they will differ according to the type of the project itself. The basic key logic that we have is here is that assets is equal to liabilities plus shareholders equity. But from the planning point of view, this is what we want. From the planning point of view, what you will have at the end of the day, you will have years. This is year 0, year 1, year 2, year 3, year 4, and then you have the total. You need to have your assets. You need to predict those assets that you will have at year 0. How much is that one? You need to know how much cash and cash equivalent at year 0, 1, 2, 3, and so on. Any other receivable that you predict yourself, you see. What about stock? Are we going to have a stock? You see, you need to predict. If it is stock, you will have in year 1, indicate in year 1 how much is that one going to be, and also you need to predict any type of your prepaid expenses. As we say here, it is all based on the type of the project and also the capability for yourself as a project planner to predict properly. So you need to get some times and predict properly all those assets so that you may find yourself have the pro forma balance sheet. So you will need to predict all your plant, your equipment, your land, buildings, your fixtures, your equipment, any other things that you consider are part of your assets. You must include that one. But remember, this is critical from the project planner. This is critical. Why? Because we are planning from year zero. So we needed to know how much will flow at year zero, and how much will flow at year one, and how much will flow at year two, and so on. Now, it is also being supported with notes. Don't forget to put notes. So in terms of liabilities, you will also need to predict as far as liabilities are concerned. Current liabilities, accounts payable, advance payments on orders, income taxes payables, and so on, until it gives you owner's equity, depending on the type of project that we have. But the most important thing is we are making assumptions in here. What we will have at year zero, and what we'll have at year one, and what we'll have at year two. And remember, all these assumptions relate. If you have conducted a proper cost estimates, this will become a simple exercise, because during the cost, you will know what are the type of assets are needed. You will know all type of equipments are needed. You will know if vehicles, at what time vehicle is going to be required in the project. So that becomes significant. So any forecast you are making, make sure you produce notes to support the arguments. And when you get the total, you need to explain. Now, why pro forma balance sheet is important? Why forecasted balance sheet is important? Why? We say this because we are based on the assumptions. Despite many assumptions you are going to derive during this forecasted balance sheet, the need arises to use educated guess on possible assets and the possible liabilities that the project is going to own to allow smooth operation of the project. And that's why you are supposed to forecast this. Your project cannot be funded if it fails to demonstrate current and future flow of assets and liabilities. It will be difficult for you to get funding unless otherwise other situation prevails. So for us, what we say is we look at those assets and liabilities required during the period, the future. Now, the future lies within the assumption. Now, any assumptions you are making, that whether the assets is going to appreciate or depreciate and so on, please, those are the notes you need to explain in the plan. You need to explain. And failure to that, it will be difficult for you to be understood within the commercial banks, especially for bigger project. For bigger project, it will be difficult for you to be understood by the commercial banks. And also, so that is the balance sheet. That's the balance sheet or statement of financial position. Now, you also need to attach an income statement. Income statement. The main reason why we have to produce income statement, because we are interested in focusing at profitability. So you should know this is the main reason that makes why do you set your project? You are setting your project because you are interested of making the profitability. So that's why you have to prepare this one. And we need to know the annual profit. And we also need to know how much is going to be the accumulated profit. These are very important. And we need to know whether we are going to make loss or we are not going to make loss. And this is significant during the planning. And therefore, we need to include in our income statement. Why income statement in the project? Of course, planning ahead. We want to obtain loan from banks, and the banks will ask how much profitability are you going to generate at the end of the day. Developing business partners, other partners, and other venture capitalists that we think they can join in our project. Project can be so huge. You're about to construct a road from Arusha to Simanjiro. You know how many kilometers. So you can look potential venture capitalists to join hands with you to determine how much tax are we going to pay, keep track on expected profit growth rates, and it is a point of reference and benchmarking for the project manager. And also we wanted to assess the future profitability and growth. And generally what we say here, it must include income, and it must include all income or revenue streams generated by the projects. And also you must have gross profits. This is the excess of sales revenue over the cost of goods sold in the period. So you will have purchases, cost of goods sold. You will have purchases, less closing stock, less when you deduct this one, it gives you cost of goods sold. Cost of goods sold. You will have operating expenses that includes all overheads and labor expenses associated with the operations of the business, total expenses. These are the sum of cost of goods sold and operating expenses over the period of time, less the total cost. Then you have net profit after tax. So you must know this. It shows the net profit after tax. So the most important part for us as a planner, as I said, we are not intending to become an accountant in here. We are intending to become planners, and all our planning are based on the assumptions, and our assumptions will provide the best arguments on how we see the future, because every person will see the future from his angle. But for you, you are being backed up with a proper assumptions that can be predictive, that can be the base for you to argue. So in here, what you need to have in your structure and as part of our planning, this is what we need to have. This is what we need to have. We will have the income statement. Remember, we will have years. Years, we have year 0, year 1, year 2, then the total. I think everybody can see in here. Everybody can see that. Then we have the total. So you depending on the lifetime of the project, it can be a project of 10 years. It can be a project of 15 years. It can be a project of maybe 20 years. It will differ. But for us, we say we must have year 0. We must have year 0. And what are the assumptions? Do we have sales at year 0? If we don't have, we just say we don't have, it is dash. Now, how much quantity do we want to produce at year zero? Remember, you must link with your cost. You must link your revenue in here. You must, if you have done proper revenue estimation, then here it becomes simple for you to start importing your data from revenue estimation. So you will have your sales in here, less cost of goods sold, and add purchases of goods, and also less stock at a cost, maybe depending on the stock available. So you will have it at the end of the day. You will have your gross profit, and you can add any sundry and so on. And then remember, you will have to deduct any, if you have your gross profit in here, you will have to deduct any expenses from administration expenses. That includes rents, rates, light, telephones, postage, insurance, stationaries, and so on, until it gives you, when you look here down, you will have your net profit before tax. You will get right there. But do you ask yourself, do you need this at year zero as net profit? You cannot. It's difficult. It is difficult at year zero. This is revenue has not yet started generated. Well, again, it will depend with arguments and the type of projects that you are putting. So at year one, what about year one? At year two, what about year two? Total, and so on, and so on. So all this will give you your income, statement. But as I said earlier, you must support with notes for any assumptions that you are making to try to predict the future. You must make some assumption on that one. Now, when we talk about this, we are not limited to this one, but we have also the cash flow. The cash flow. Now, the cash flow can be shared like that. This is one of the example that a project planner will need to develop at the end of the day. And the cash flow that we are talking about right here, our interest is to know available how much cash the project is going to generate, how much cash the project is going to generate. And that is our interest. So you will have right here, as a matter of knowing what are the items that you need to include during the estimates. You will have the cash receipts, if any, the cash sales, returns and allowances, collections on accounts receivable, any other inflow you will include in here. But again, these are months, but it can be developed in terms of years. Then it will give you the total. This is how much is your cash inflow coming. So you need to predict the inflow for the project. I think based on the tuition fee, how much is going to be the flow? How much is going to be the flow? Then you will have some receipts from tuition fees and predict that one according. You predict that one accordingly. And what should be some payments? So the cash payments in here is the cash receipts, but again predict the cash payments, just like the way we say in here. You will have to say cash paid out cash paid out, how much is that one? So from advertisement, from commission, from contract labor, and so on. So you will need to define all these items depending on the types of the project until it gives you the total. And then at the end of the day, you will know how much cash on hand at the end of the month you have. So you will have to find out that one. And if you have any other operating information, you will need to include in there. You need it to include in there. But anyway, you can do that one, and it becomes useful if you go into practice. If you go into practice from planning point of view, it becomes easier. But as I said, we are not intending to become an accountant, or rather we are intending to become planner, and most of our planning are based on the assumptions that we are making. Let me stop here for today until we meet next session again. Thank you. I wish you the best.